All right, guys. Well, welcome. Thank you so much for joining today's session. I think it's going to be a great one. We're going to cover the 10 mistakes that people make in real estate, right? And I'm primarily focused on multifamily. Now, if you guys don't know me, my name is Agostino Pintus. I am a multifamily investor, developer, getting into triple net leases as well, and primarily I invest in and around Cleveland, but I'm actually here right now from Florida. I'm in Sarasota, Florida, and we're looking for other assets to acquire down here, mainly multifamily. We're also looking at development opportunities and also hotels and things like that. So we're trying to expand beyond what we currently do. We have a fairly sizable portfolio of multifamily real estate. We acquired the Rockefeller deal in downtown Cleveland. That's going to be a $13.5 million asset, purchase price. Plus, we are going to put probably another 85, $90 million into the asset to make it better. I'm currently locking up another 500 unit deal. We just recently closed a 150 unit deal. I mean, we're very active. And the reason why I'm pointing this all out is not to show off. I'm not, that's not the whole reason. I'm telling you this because this is all this information I'm giving you is coming from an actual experienced investor. This is what I do. This is what I do for a living, right? So you're not getting it from some dreamer, right? So this is the real deal. It's what I do, right? So like I said, today we're going to cover the 10 mistakes, and so let's just jump right into it. Mistake number one: not buying in the first place. So many people, what they'll do is they often think about buying, they think about getting into the game, they think about doing something, but something is holding them back from taking action, right? So what do they end up doing? They end up going to the seminars, reading the books, listening to the podcasts over and over and over and over and over again. But the action is never taken because they just don't have the knowledge. And here's the thing: many people won't take the action because they don't have the knowledge and they're scared. It's usually fear that holds people back, right? And the way you overcome that fear is to get the knowledge, right? Once you get that knowledge, then you'll feel more confident about taking that step into a deal. Now, as easy as that sounds, right? I'm sure people out there saying, "Oh no, I'm not afraid. I'm not afraid of doing a deal. I'm fine with it." Well, we have to also understand the psychological aspects of what we do as humans, right? We will often trick ourselves into doing a lot of different things. I remember your brain is created and evolved over time to keep us safe, right? This is why people enjoy Netflix and chill, sitting in front of the TV, relaxing, watching TV, right? It's easy, it's simple, and our brain wants to keep us safe, right? That's what our brain is designed to do. So you can either, to the brain, take a risk in a new deal, a so-called risk, or you can listen to this podcast and your brain convinces you that you're doing what you need to be doing. Okay. And here's the thing: I promise you, in a podcast, yeah, you'll learn something, but unless you're taking action, nothing happens. Nothing happens. You have to take that action. And what does that mean? Well, that means either getting a mentor, getting some help, joining a group, finding a partner that can get you into a deal, something along those lines, anything to get you into taking action. Is it going to be scary? You're damn right it's going to be scary. It's going to be very scary. My first deal, I was scared, and then after the first deal, the second deal becomes a little easier. The third deal becomes a little bit easier. I'm on deal number, I'd say 22 right now. It's super easy, and they're getting bigger and bigger and bigger as I go, right? So that's a great thing about doing this business. Or like and the thing is that this applies to anything that you do, right? And but step number one is actually buying something, buying anything, right? And I have certain rules about what to buy and how to buy it as well. I generally, for people just starting out, depending on your market, I don't like buying small. I think buying small has its own risks. But I would say that if you are going to buy something, get something you can keep an eye on, that you can self-manage even if you had to. and something in the, from I'd say 2 to 10 units, and from 70 units and up, right? There's this dead gap in the middle here. And this dead gap, that's what I call it anyway. Property managers either think it's too small to manage, it's too big for you to self-manage, and it's too small for a property manager to manage, and they won't make enough money on it. That's what I figure is the dead zone. I would avoid, especially for new people, that I guess that band of properties, right? So roughly, let's say 11 to about 69 properties, unless you could find a really, really good manager and you can scale in that general vicinity very, very quickly. That's generally what I recommend. I mean, I'm just covering all the 10 spots, the 10 mistakes here. There's a whole lot more theory behind it as well, but I want to get through everything so you guys have the knowledge and you guys can still get back to your noon time. So what's mistake number 2? Buying too small. People are often scared that those bigger deals are riskier. Okay. This is 100% false. False, false, false. The bigger deals are easier to do and less risky, far less risky than the small ones. All right. I'll give you an example. All right. There's a deal I'm working on right now. Okay. The seller is a REIT, and it's a huge deal. It's over $30 million. Huge deal. This deal, they want to handle the financing for us, right? They actually have a lending arm. On this deal, they say that they can get us a sub 3% interest rate, interest only for 2 years, and a 35-year amortization. Okay. Now, if you look at a 22 unit, for instance, and you call your local bank or whoever, even your Huntington or Bank of America or whoever, I don't even know if Bank of America does these types of commercial loans, but let's say they do. You're going to find that those interest rates are going to probably be like 5%, 5.5%, sometimes even approaching 6%, right? No IO, no interest only, none of that stuff, right? With all kinds of other prepayments and things you're going to have to do to stay in the deal. Now, think about it. Why is that? Why is that, right? Why is there a higher interest rate? Higher interest rate, higher risk. That's the reason. Those smaller deals are far riskier than the bigger ones. That's the reason. That's the reason why. Now, what I've been recommending to people that we coach, that we educate, that get into our programs is because of the tightness of the market right now. I'm recommending it's like, okay, look, get into a small deal, get in, build your resume up, keep it for a year or two, and then get out. Get in, hang on to it, get out. Get in, hang on to it, get out. Don't keep it long term. And again, it depends on your circumstance. It depends on where the asset is. There's a lot of dependencies here, right? But generally speaking, you want to try to scale into the larger deals. The larger deals have far more cash flow to handle some of those incidental things that crop up, right? That is the key thing. I mean, because unless you have an A-class asset, it's usually pretty steady, right? It's usually very steady. There's not too much that goes wrong with an A-class asset. Everything is new. But in a C-class asset, like the asset that many people starting off in this business anyway end up buying or getting into, there are all kinds of things that crop up that in order to be prepared to handle those things, you have to have good, strong cash flow. You have to have good tenants. You have to have a good neighborhood. You have to have all those things that are needed to make the asset work, right? That's the thing, right? So that's why it's like on typical smaller deals, especially in that C asset range, it's going to be very, very tough to do. So by the way, guys, if you have any questions, something doesn't make sense to you, you don't know what I'm talking about in terms of asset classes or whatever, just interrupt me, say something. It's perfectly fine, right? So I don't want this to be like a one-way conversation, just me dumping information out on you, right? So unless you want me to, that's perfectly fine too. All right. So let me see. All right. So number 3. All right, number 3, buying on a budget. Okay, that's it's it's funny how people buy on what they think they can afford. And incidentally, when I bought my first deal, I did it with my own money, and it was a small deal. It was a deal where I had to just acquire the asset, and I wanted to demonstrate to my investor team that I was going to be building that I am in the game. Okay, so that is certainly one way to do it. That's not the only way to do it. There's many different ways of handling it, right? But that's what I did. So I went on the affordability route. Now, if I would have known then what I know now, I probably would have done things very, very differently, right? But again, it comes with that point number one, knowledge. You got to have knowledge, right? And so here's the thing, though. If anybody on this call, has anybody been looking for assets, like really on a daily basis, hitting LoopNet, talking to brokers, looking at deals? Has anybody been running numbers? Has anybody? Go ahead and either put your hand up or on Zoom, or just turn off your mic or turn on your mic and just tell me, has anybody done it? So yeah, I see a couple here. If that's so, it's tough finding a deal. It's hard finding deals, right? And that's the thing, it's harder to find a deal and make the deal work. And I think that if you are successful in finding a deal and at the same time building those relationships with other people in the business, right? And you're able to present a deal to that someone to say, hey, look, I have a deal. I found it. I've been looking at all these deals. I know my numbers. I know what I'm looking at. I know here's the opportunity. Here's why it makes sense. Here's why I love this deal, right? If you're able to do that, then the amount of money, the budget doesn't really matter all that much, right? The kicker is that you have to know your numbers. You have to speak with conviction. It requires a great deal of practice. Getting the deal in front of a good deal is going to be hard for someone starting off. That's the thing. But again, understanding what you have to say, who to a broker, to the lenders, all that matters. So, and by the way, if you text the word freedom to 202-410-4202, there's a couple free ebooks that you can get as well. So go ahead and do that if you haven't already. If you guys haven't downloaded those free ebooks, I talk a little bit more about how that stuff works. But building that credibility to get your hands on the good deals is going to be everything. But more importantly, like I said, for point number 3, buying on a budget, don't buy on a budget. I've been talking to brokers here. One broker asked me, well, how much do you want to spend on a deal? I'm like, I don't care. It's really NOI is what I care about. I want NOI. I want to know what is the net operating income. And I base it off of there. Right? I base it off of that. NOI is the most important number. We're going to get to that here soon. So number 4, believing in the pro forma. You believe in the pro forma. Now, it's funny that I have a joke that I tell my friends. Pro forma is a fancy word. It's an old Latin word for fake financials. Right? Of course, it doesn't mean fake financials, right? In Latin. But typically, when you look at a pro forma that's put together by a broker who's trying to move a property, it is not only the absolute optimal thing is that if nothing goes wrong, this is perfect and everything goes great. This is your expected returns and look how phenomenal it is, right? It's not always the case. Not always the case at all. And especially when you're getting into some of these older properties, again, like the C-class assets, maybe B- assets that many, especially new people are getting into, which again, I did that. Many of my friends that are in this space have done it as well. It's usually how the process goes. Usually they start off with the older assets and work their way up. But what they'll do is they will believe the pro forma that the broker put together, and it'll have like a 45 or a 50% expense ratio, meaning that the expenses only represent 50% of the gross income. So you have the gross income, all the money that comes into the property, then you have all the expenses, taxes, insurance, maybe you're paying for water, maybe you're paying for some heat in the common areas or whatever the case may be, trash pickup, security, maybe all the other expenses that come along with the property, laundry, whatever, it equates to like 50% of the gross income on a C-class asset. Not likely at all, right? Craig, you had something?
How much weight do you put into trailing 12?
Well, okay. If you're talking trailing 12, like a real trailing 12, if it's real, then the trailing 12 is the trailing 12, right? But if it's like pro forma, like so somebody sends you an OM, they email it to you. I know right away that I'm dealing with a bunch of crap when I see like 40% expense ratio. I've seen it on a C-class asset. I've seen it, right? Now, if somebody sends you a T12 and it's supposed to be on a C-class asset, say in Ohio, okay, C-class asset in Ohio, and I'm specifying Ohio because Ohio, we have the weather could be fairly brutal in wintertime, for instance, right? These buildings take a greater beating. It gets very, very cold. It's a little more expensive. Depending on the area, maybe your legal costs might be a little higher than normal. I know the expense ratio for a C-class asset typically will sit in the high 50s, usually 60%, somewhere in that range, and I know that I'm safe. Now, I might be a little conservative, and when you have scale, you're able to drive that number down. I get it. However, if you're T12, you're looking at T12, which T12 means trailing 12, for those of you guys who don't know what that means. Trailing 12 meaning that over the last 12 months, how did that property perform month over month, right? If they're saying 40%, then they're probably hiding expenses. They're not being entirely truthful, right? Part of it is understanding that market, understanding the asset, knowing what's going on in that asset, which is another reason, Craig. That's why it's like when you're looking at a market, you have to really look at other assets in the market. I mean, even go to LoopNet, and you don't necessarily buy anything off of there. Just start practicing numbers. I call it running the numbers, right? It's like pick a market and run those numbers and see what people are putting out there. Because I think you're going to find that, let's say, for instance, you're targeting Memphis, Tennessee, okay, and you're looking at, I don't know, you're running 10 deals a week, all right. So I don't know if you'll find 10 deals a week on LoopNet or some of these other Crexy or some of these other websites that they have out there. But let's say you do that, right? Then you'll notice there's a pattern when it comes to expense ratios, for instance, right? Maybe it'll hover between that 50 to 60% ratio, but all of a sudden you get a T12 and it says 40. You should be suspect of that. Then you can push back and say, "Are you sure this expense ratio is right? Looks a little low to me." And I've said that before, Or there's like 5 lines on the expense ratio, or it could even work out in your favor. I've looked at properties where the expenses were super high, because maybe they're charging a property management fee. They had 2 property managers on site and then five maintenance people. I've actually bought properties like that, and I'm like, oh, beautiful, love it, because now you can implement your own management team on there and then fix all that up. So part of it is knowing the expenses and how much it should be. That's really what it is. Yeah. Hopefully that answers your question.
Well, yeah. I mean, I wonder if I have to admit that I'm already violating rules 2 and 3 because I'm buying with for myself and with my own money and trying to keep the amount of units smaller, and obviously we're trying to keep it on the budget too. So I'm already violating 2 of those rules. But when I do see some of the trailing 12s, I'm wondering with some of these smaller deals, 20 to 30 units, if the landlords or the owners know they want to sell. And so then the year before they start planning for it and say, okay, I'm not going to spend any money to show that, this place is beautiful. It makes a ton of money. But then when you get it, you realize that there was a whole bunch of deferred maintenance. And, I just wanted to see if you've seen any like trailing 12 really not being accurate.
Yeah. And I think you're going to find that in some of the smaller assets too. And I'll tell you why, because it's actually, that leads me to number 5 is underestimating those expenses. That's number 5 right there, right? Because to your point, Craig, here's the thing. When typically those smaller properties, 20, 30 units, 40 units, like I said, all the way up to like 69 units, 65 units, you're going to find the mom and pop type of operators. Sometimes they go beyond that, right? Maybe they have one asset. I did meet a lady one time, she had, her husband had bought this property. There's like 100 units. They owned the whole thing outright. She was managing everything on pieces of paper and a pen, and it was ridiculous, right? But she's a mom and pop operator, right? Again, nothing wrong with that. That's fine. However, she's not including property management, right? And property management could be, on smaller properties, it could be upwards of 10%. And the more units that you have, the lower that rate goes, So if you have enough units, you could be paying 3%. Maybe you have like 2,000 units. Now your management rate becomes 3%. Here's what happens though. When you look at that T12, or you look at the expense line, or you try to find that expense line, you won't find it. It's not there, right? Someone's got to pay for that. Whether the building is paying you to manage it or is paying someone else to manage it. And people underestimate that stuff. They just don't even think about it. They don't think about, oh, well, there's no property management fee, or there's no water fee in there, or there's tons of deferred maintenance, like a ton of deferred maintenance, because the guy, just like I said, he decided last year he's going to sell it. He's going to try to limp along, patch things up just to make it look good, bang up the T12 a little bit on the income, and then hopefully pass it on to somebody else. That's exactly what happens. So that happens quite a bit. The biggest thing on the smaller properties, anyway, that I've seen is the lack of property management fee, and that in itself will kill you. Number one. Number two, I find that for whatever reason, insurance always seems to be much higher than what I'm able to get insurance at. So I'm not sure why that is. What I typically do is I align myself with a good insurance company. I've been doing business with them for years. And but every once in a while, you got to do champion challenger. And what that means is that, you've been using this group for a long time, or I've been using my group for a long time. Oftentimes, you know what? I meet a new carrier. It comes highly recommended from a friend of mine. I'll say, hey, go ahead and quote everything out. Let's see how he does. I'm not saying I don't trust them, but it's kind of like you want to keep them honest. And I find that many people just don't do that. They just don't do it, and this is part of operations. It's kind of like you have to do that kind of stuff. What else is there when it comes to expenses? I saw once on one asset where they had a different group handle electricity. So rather than the city handling it, there's some sort of, some multi-level marketing thing going on. And they got this group, and the electricity was far higher in the common areas. It's like triple of what it should have been. Once we knew that, we saw that, but the other people just kept on running this that way for years. They had no idea. They had no idea. So, but we saw that as a problem. So really, again, what it comes down to is knowing what your expenses currently are, what they should be, and what's missing. And I think you're gonna find that more on the people that do the mom and pop thing. It's all manual. You're gonna find it's gonna be on just an Excel spreadsheet. On the larger assets, those are probably going to be in like an Appfolio, Yardi, one of these systems. If someone's doing their job, their job right, it's going to be tracked properly. But you know what, though? It doesn't matter what the deal is, the number of units. If the data is not there, you should be suspect. And no matter what, even if everybody seems very, very nice and kind and they're always nice to you, always be suspicious. Always look for a reason to kill the deal. Always. That is your primary mode, is to try to kill the deal. Try to kill it. And if it passes everything, then you got a good deal on your hands. So generally speaking. Let me see. Number 6, not funding those capital costs. So roofs, carpets, paint, all that fun stuff. A big mistake that many people make is that they count on the cash flow to support all those capital expenses. There's actually a large group that I've heard of recently here not here in Florida, but up in Cleveland. They're buying these assets, and they were over leveraging. They're trying to use as little money as they could to get into the deal, and not accounting for new carpeting, new paint, new signage. Maybe you want to rebrand it because it has such a bad reputation online or something like that. Maybe you need a new sign or something. Maybe you want the common areas like dated and terrible. Maybe you need new boilers or water heaters or whatever the case may be. And they're counting on the cash flow to cover all that stuff. Huge, huge, huge mistake. Don't do that. Don't ever do that. When you walk into a deal, if you're not sure, bring an inspector with you, bring a contractor with you, bring someone you trust with you, right? You may have to pay them for an hour or whatever of their time, fine, slide $50 over their way. It'll be the best $50 you ever spend if it saves you a bunch of time and a whole bunch of headache getting into a crappy deal. You don't want to do that. You don't want to do that. Slide $50 over to a contractor, have them walk around with you, right? Someone you trust that knows their stuff. They got to know their stuff, right? That's the big thing. But like I said, many people, they just underestimate their expenses. They just don't include it. They just don't include it, right? What you should do is when you're looking at the property, look at the boiler system. Is it super old? Like, is it the original boiler system from a property built in the 1960s? Chances are you need a new boiler, right? Chances are. And this is another thing that you can also do, by the way. Let's say, for instance, there is a boiler from the 1960s. Okay, then you look at the P&L, and their gas bill is super low. Why is that? Those things aren't very efficient, right? So you should always be questioning stuff like that. It's like, why is this gas bill so low for something so inefficient? Hey, can you show me the gas bill, please, as part of the due diligence? Or maybe you do that after the contract. We'll talk a little bit about that in a second. But you want to try to find the little gaps. You want to try to find the little holes. It's part of due diligence, which we're going to be talking about here in a second. But those are the things that people they just don't include the capital expenses. So what does this mean? What do you do now? If you know your numbers, how much it costs to repair things, like I said, bring a contractor with you, walk through the property, have an understanding. Okay, this common area looks like it's 10 feet by 30 feet. And I know roughly it costs $2 a square foot to prep this space. Okay, so how many square feet is that? How many square feet is that? Add it up. You come up with a number that you're going to need to clean the place up and fix it. And that goes into your analysis. And that goes into your raise, right? When you go to raise that money down the road, if you decide to go do that deal, you have the purchase price, of course, but you have your how much you're going to leverage, usually 20, 30%, depending on where you get the lending from, plus that capital expense, right? Always have that up front. So when you go raise the money, it's all there in the bank, and you can just execute on the business plan. And it has to become part of your business plan, by the way, too. When you go talk to your investors, they're going to ask you, hey, what are you going to do to this property? You can't say, I'm going to replace the boilers, I'm going to change out the water tanks, I'm going to do all these things and not have any money to back it up. You have to protect their money, and part of it is investing in the right deals and making sure that all that stuff is accounted for. So that part is huge. Number 7, under leveraging. So I touched on over leveraging a second ago, but under leveraging is probably one of the biggest mistakes that many people do. And that means not borrowing any money at all, right? Not borrowing any money at all. The thing that real estate does best is it amplifies your money, right? There are very few places that you can take, like, say, $200,000 and control $1 million asset. There aren't too many things you can do that. I mean, hell, not even a bank. Not even a bank will lend you money to buy their own stock, but they'll lend you money to buy real estate. Why is that? Because they know that real estate throws off cash flow, and a stock may not actually throw off cash flow, right? There's a reason why they do that. But what does that mean, though? Let's say, for instance, you have $200,000 or $300,000 lying around, and you go buy a property with it. but now you got all your money tied up in a single property. All of your money is tied up in a single property, right? Now, it's nice not having a mortgage on it. Sure, that's great, right? But now you have all this equity sitting here, not working for you, right? It's just sitting here. But if I can take all this money, let's say it is $300,000. We're going to talk small for a second. And I leverage this $300,000 into 3 properties that are all throwing off cash flow every month, and I get a low rate mortgage on these 3 assets. Maybe if I don't know if it's a small property, like I said before, then I have cash flow coming in, right, from all 3 properties, and I'm using leverage to amplify that money, right? I see people doing that all the time. I see people doing that with the house that they live in. Oh, my house is paid off. If a house is a great investment, then why are people rushing to pay it off? You know, because it's not an investment. It really isn't. You know, it's people are paying money into a liability is what they're doing, because they're leaving the money just sitting there, not doing anything. The money is not working for them. Many people don't understand that concept. I mean, I was never told this when I was growing up. My parents are always trying to rush and pay the house off. You know, it is a crazy concept. If a house were a good investment, people wouldn't be rushing to pay it off. They want cash flow, right? They would want to have that cash flow that's coming in. Number 8 is not scaling. You know, that's probably one of the biggest things that people don't do is they don't scale their business. And keep in mind that real estate is an actual business, right? There's a P&L statement, there's a profit and loss statement, there's a balance sheet that comes along with it. There's people responsible for the property. You're registering an LLC with the city and the state. I mean, it's an actual business, right? And many people, what they'll do is they'll keep it small, right? They'll say, oh, you know what, I'll just get 100 units and be okay. And you know what, and maybe you will be. Maybe that's all you need to get started, and maybe you're happy doing that. The thing is, though, is that for many of the people that, like early on when I was buying assets from people, they did that. You know, so it works out better for me. I can find assets and get a good deal on them. But unless you're scaling and growing, nothing happens, you know, to your business. And in my opinion, anyway, I'd love to scale and grow my business. I really think that if you're gonna keep up your own household cash flow going, you want to do the same sort of thing, because remember, the dollar is losing value every single day. When they're talking about giving away all the stimulus money to all these different people, right? Who's going to pay that bill? We are. All of us are going to pay that bill, right? So what does that mean then? That means that the dollar is diminishing in value. So what does that mean for you? You need to keep growing your business, is what it means. You need to keep adding more assets to your portfolio, right? So I would highly suggest that for you guys out there. Keep looking for assets, buy something, keep that forward momentum, keep looking for properties to buy. Even if you are fine, you know what, for many people, if you're in the single family home space, you're probably okay doing 100 single family homes and everything's doing great. You know, you and your family are doing super because all this money is just coming in. There's enough cash to keep the properties well maintained, and that's fine. But let's say, for instance, something happens. You know, let's say, for instance, there's a moratorium on rent. Now what do? Right? You have to make sure you keep that growth going. You know, that's because you never know. It's kind of like planning for a rainy day is the way I look at it. Number nine is probably one of the biggest things that I hear about all the time is buying on cap rates, right? I can often tell someone who doesn't have a lot of experience in real estate, the first thing they ask me is, what's the cap rate? What's the cap rate? You know, and cap rate is, it's a, how should I say? It is applicable in certain scenarios. I use it mainly to identify the type of area that it is, as opposed to the type of asset, okay? So, and we're talking multifamily here, right? So if we're talking a 10 cap, oh, it's a 10 cap deal. You know what? Hey, you know what, Sandy? I got a 10 cap deal for you. It's freaking awesome. It's 10 cap. It's a 10 cap. I hear 10 cap and that scares the hell out of me. Why does that scare the hell out of me? Well, that tells me that the property is probably in a not so good location. It's probably like the windows are all blown out. I'm going to have to deal with bad tenants. I'm going to have to chase them down for rent. I'm probably going to need a gun and a bulletproof vest to go there to collect. That's what it means. That's what it means, as opposed to like, oh, well, this property it's only a 4 cap. Well, you don't want that. Well, a 4 cap is going to mean an A-class asset. That means that it's going to be a better property, better performing with, it's going to be very safe. You're going to have people that are going to actually get to pay on time, things like that. That's cap rate I use is mainly for area. I don't use it for the actual asset itself, right? It's irrelevant. What matters is NOI, net operating income. That is what you want. You want to know NOI. So just be wary of those brokers that'll call you up and they'll hit you up immediately. They'll slap you across the face with a cap rate. Well, no. You want to know what the NOI is. You want to know more about the property. You want to know more about the area. You want to perform your own due diligence to understand that area and what it is. That is absolutely important. Absolutely important, right? That's more important than anything else. If anything, the cap rate of the asset, the cap rate of the area will tell you what it is you're buying, right? Are you dealing with high crime? Are you dealing with low crime? Are you dealing with people that maybe the income level is super, super low? Where there's low income levels, you're going to have typically a higher crime or higher unemployment in that area. Unless you know how to manage those types of assets, you may not want those types of assets. That's the thing. I mean, if you're a pro, I know some guys that totally love those assets and those D+ type of areas. All the power to you. I don't do those types of assets. I'm not good at it, and that's okay. I don't want to be good at it, right? But you have to understand what that means, right? So never, ever, ever just buy on a cap rate. It's not about that. It's about performing the right due diligence and understanding what it is that you're doing. And then number 10, not committed to learning. It's like I'm glad that everyone is on today. I'm very, very, very happy, and we're going to be releasing the recording of this show afterwards. But I'll tell you, there's so much to learn in this business. Not only from how do you analyze a property, how you analyze a portfolio, how to hire people, how to find a property manager, how to talk to brokers, what to say it, how to build credibility with them, all that stuff. You have all that. But then what many people don't cover, we cover it on our show, is the sales and marketing aspect. The raising money aspect is super important. The mindset, right, of how to portray yourself and how to really convince somebody that they need to be selling that property to you as opposed to someone else that might be competing with you on that asset, right? There's so much that goes into really taking down a property. And what I find is that for some people anyway, they don't really commit themselves to lifelong learning, right? So we have a book club as well. So it's like, it's a free book club. It's just a list of books. I'm reading a book a week. It's typically what I do. And in my book club, and what I do is I read stuff on psychology. I read stuff on sales, marketing, leadership. It's funny, a lot of that stuff, I do touch on real estate, but it's more along the lines of how do you develop yourself into becoming a better leader? Because here's the thing. If everyone on this call right now is looking to expand and grow their business, it's going to require you to expand and grow your mind and become a better leader to get through the tough times. Because believe me, in this business, I don't care what all these gurus say. All right, this is not like for the faint of heart. Or you're going to buy a fourplex. You're going to be moving to Miami, and you're going to get a Ferrari next week. You're not going to do that. All right, maybe you will eventually, but not next week. It's going to require a whole lot more work than that, and it takes a lot of grit to make it. That's what it is, right? And to make it through those tough times, to make it through those heartaches that you're going to be facing, to lead those people that they're going to rely on you to make good decisions about what it is you're buying. Uh, your property managers, your investors, your general partners, all these folks, you have to become a reading machine. Read everything you can and really devote yourself to studying and learning. So aside from that, learning the market is also important too. You know, like I said before, like I touched on it before, right? If you're going to go into a new market, start running deals in that market. Understand what's going on in that market, right? Committing to that education is super important. And what I find is that some people, like, they'll just topically go over it, but there's so many free resources out there, like Crexy. I touched on that. I talked about that a second ago. LoopNet. Those are the two that I don't really go to those websites. I don't even know all the whole. I have a whole list of them. I never go there really. I rely solely on brokers to help me find deals. But if you go and start looking at those and you start running your numbers and practicing and understanding that market, that's also huge as well. So there's two things: committing to your own internal knowledge, right, through reading books and really committing to that. And then secondly is understanding the market. Become an expert at your market. Know every single deal that goes on. Brokers will call me up and they'll say, oh, hey, have you heard about that deal? Yada, yada, yada. I'll be I heard about that deal like 3 weeks ago or a month ago, you know, or whatever. It's like, you need to be like that. You need to know what's going on in your market and the market that you plan on going to, right? Super, super important. Absolutely super important to do that. So, those are the 10. Did anybody write that down or have any questions, or what are you guys thinking? Did you like that? Did you hate it? Is it thumbs up or thumbs down? What is it? What's going on?
How do I start finding my people to have on my investment team?
Excellent.
How do I find those mentors?
Good question. Good question. You know, so here's the thing. Here's the thing, Miranda. It's when I first started I'll take a step back. When I was working in corporate, okay, I would submit a resume, right? If I wanted a job, and then they would look at this piece of paper, and they would look through my experience. They would look at my schooling, my education. Maybe they look for references, and it's like, who's backing me up, right? Who's on my team? Who's going to vouch for this guy, right? They don't know. Maybe they'll do a Google search on me, right? But here's the thing. That same process happens when you are looking for investors. It's the same thing, right? And here's what I mean. You have to know how to talk to those investors, how to get them on your side. And you do that by building credibility with them. So how do you build credibility? Well, if let's say for instance, you had a presentation, a PowerPoint presentation that talks about you, your experience, your background, talks about your team, because here's the thing, I'm going to assume, Miranda, you have no experience. You've never done this before. All right, I'm going to assume you know nothing about it. Okay, that's okay. And I wasn't trying to berate you or anything. I'm just saying I'm going to assume, just so like level out the playing field, right? Because at one point I knew nothing about it either, right? Just to be clear, it isn't like I was born yesterday and boom, I know everything about multifamily. That didn't happen to me either. But what you do is you rely on a team. It's your team that matters, right? So now you have to become very good at talking to your team, at convincing them that you can pull up, you actually buy deals, right? That's going to be the toughest part, right? But once you do that, now you prepare a document, you prepare a presentation that really helps you demonstrate to investors who you are and what you're about, right? I also practiced how to speak. I actually practiced how to get on the stage, talk to people. I practiced sales and psychology. I mean, it took me a while to do all that. I mean, I was very lucky that because I worked in corporate America, I had some of that training already, you know, in terms of, you know, just talking to people on a regular basis and negotiating certain things. So I kind of already knew how to do that part. But if someone that's coming straight out of like from that's never done it before, this is why I mentioned number 10 is that the sales, the marketing, all that needs to be on point. Because think of it like this. Let's say, Miranda, that you suddenly create, after this call, you sit down and you create a PowerPoint presentation. All right. Listen, before you even do that, take a piece of paper and a pen, title, who you are, what you're about, who's your team, what type of property you're going to buy, where's the financing going to be coming from, like who the lender is, all that stuff. Then from there, you're able to present it to people, and you practice on other people first, on your family members, before you actually go and target people that are really interested in investing in deals. I mean, it's not easy. I'm going to tell you that right now. It's not simple. It takes work. But if you download those 2 books, I go into a little more detail about it as well. So, or rather, if you text the word freedom to that 202-410-4202, there's a free ebook on there, 2 free ebooks. One of them's on raising capital. I talk about this, right? I talk about it. So check that out. As far as mentoring, we do mentoring as well. So we have an online course as well that's going to be coming out soon that really helps with that part. But in-person mentoring is probably the one thing that I didn't do that I should have done. It would have saved me a whole ton of time if I would have done it that way. Yeah. Oh, Linda, it's Crexi. Crexi is the name of that website. So that it's a CREXI.com. It's like a competitor to LoopNet. Yeah, it's like a competitor to LoopNet. So here are all the 10 points. All right, I'll spit them out one by one. Okay, so point number 1 is not buying anything because you just don't know, you're uncertain. So getting over that fear. Number 2, buying too small. Number 3, buying on a budget. Number 4, believing in the pro forma. Don't believe the pro forma. Remember, pro forma is Latin for lies. All right, just keep that in mind. Number 5, underestimating your expenses. Number 6, not funding your capital costs, right? So not accounting for them as you walk the property, right? Remember that. Number 7, under leveraging, not borrowing enough money on a deal. Number 8, not scaling fast enough, right? So keep the momentum going. Number 9, only buying at a cap rate. Remember, you're buying on NOI, you're buying on net operating income, not on cap rate. All right, remember that. And number 10, you have to commit to lifelong learning, right? You have to commit to that. By not doing that, you're making a big mistake. Cool. Okay, guys. Well, I want to give you back some time for your break here. So by all means, if you have any questions, feel free to go to the bulletproofcashflow.com website. There's actually a link there. You can record a question there, right? So I'll be using some of the questions on the upcoming shows. So please go ahead. You could do that. Also, if you have any questions, any emails you want to send me, go ahead, shoot them over. And we're going to be having a lot of other things we're going to be doing as well in the way of mentoring and coaching and things like that to really help people get into the game. All right. So thank you guys very much. Thanks for tuning in, and I'll talk to you guys soon. All right.